Hey there. Since the 2008 global financial crisis, we've witnessed a dramatic transformation in the world of finance. Regulation has intensified, and technological innovation has accelerated, giving birth to a new breed of fintech and regtech firms. These entities are reshaping our financial landscape, challenging conventional wisdom, and introducing new paradigms of financial interaction. The march of digitization took a significant leap forward with the onset of the COVID-19 pandemic, propelling us into what we now recognize as Fintech 4.0. This latest era is distinguished by the explosive rise of cryptocurrencies, the innovative emergence of central bank digital currencies, CBDCs, and their expansion of vast digital financial platforms. Together, they are redefining the ecosystem of financial services. Regulators across the globe are recalibrating their strategies. They're tasked with fostering an environment conducive to growth and innovation, while simultaneously safeguarding the market against the perils of financial concentration and dominance. The establishment of regulatory sandboxes is a testament to this nuanced approach, creating a controlled environment where new ideas can be tested with safety. The announcement of Facebook's Libra project in 2019 marked a watershed moment, underscoring the imperative need for stringent financial regulation in an era increasingly influenced by big tech. The swift regulatory backlash to Libra illustrated the new challenges regulators face in maintaining market integrity. The introduction of instruments like China's Eni and the proliferation of platforms such as Ant Financial and Aladdin signal a new epoch in finance. These platforms are not just participants, but crucial nodes in the financial network, and their operational scale poses fresh challenges for regulatory bodies worldwide. In this era of Fintech 4.0, the division between developed and developing markets is narrowing. Nations across the globe are investigating CBDCs, and there's a surge in innovation within digital identity and financial services, stretching from the bustling markets of Nigeria to the dynamic economies of the Philippines. The landscape of financial service providers has undergone a radical evolution. We've transitioned from the era of traditional banking to a time where big techs are the new power players. This shift towards digital ecosystems is transforming how financial services are conceptualized and delivered. As Fintech 3.0 advanced in developed nations, it sparked a different narrative in the developing world. In Asia and Africa, the drivers were not just regulatory responses to a crisis or the pursuit of profit, but a quest for economic development and increased financial inclusion. This distinct period, Fintech 3.5, saw the rise of services such as M-Pesa in Kenya, a mobile money revolution spurred by necessity in the face of scant banking infrastructure. Asia, with a focus on China and India, has experienced a more profound and complex fintech evolution, powered by digitally literate populations and a drive to transcend traditional financial inefficiencies. The regulatory landscape, particularly in Singapore, has fostered these developments, making the region a beacon of fintech innovation. Fintech 3.5 has been a story of necessity and ambition, supported by governments that recognize the value of technology in driving financial inclusion. This era is marked by regulatory policies that are as diverse as they are strategic, favoring specific subsectors and aligning with national goals. As we conclude, we recognize that Fintech 4.0 is not merely another chapter in financial history, but a pivotal era that has positioned fintech at the vanguard of global finance. From the periphery, fintech has now claimed a central role on Main Street and Wall Street alike. Navigating this ever-changing landscape, it's clear that the intertwined forces of innovation and regulation will continue to shape the future of finance. From the advent of telegraphs to the implementation of blockchain, financial technology has evolved to reflect the changing needs and capabilities of society. As we move forward, the story of fintech is still being written, promising new opportunities and challenges in the years to come. How did the specific regulatory changes post-2008 crisis directly contribute to the rise of fintech firms. In the wake of the 2008 global financial crisis, regulatory bodies worldwide implemented a slew of stringent measures aimed at reinforcing the resilience of the financial system. These measures included increased capital requirements for banks, more rigorous oversight of financial activities, and enhanced consumer protection laws. One of the unintended consequences of these regulations was the creation of a fertile ground for fintech firms to flourish. As traditional banks grappled with the new compliance landscape, which often led to higher operational costs and a more cautious approach to risk, fintech startups emerged as agile alternatives. They capitalized on the space created by banks retracting from certain markets and customer segments. Furthermore, regulations like the Payment Services Directive in the European Union opened up access to data from banks, mandating that they share customer information with third-party providers upon customer consent. This democratization of financial data catalyzed a surge in innovation, leading to the creation of personalized financial services that could operate at lower costs and with greater efficiency than traditional models. Fintech firms, unburdened by the legacy systems and extensive branch networks of traditional banks, leveraged cutting-edge technology to offer seamless customer experiences, gain rapid market share, and challenge the status quo of the financial industry. Can you provide examples of how fintech and regtech have specifically altered consumer behavior in financial services? Fintech and regtech have had profound impacts on consumer behavior in the financial services sector. Fintech companies have introduced innovative services that offer greater convenience, efficiency, and personalized financial management tools. For instance, mobile payment apps like Venmo and PayPal have changed how people transfer money, making it possible to send and receive payments instantly with just a few taps on a smartphone. This convenience has led to a significant decline in the use of traditional methods, like cash and checks. Moreover, the rise of online-only banks, or neobanks, such as Chime and Revolut, has redefined consumer expectations for banking services. These platforms often provide user-friendly interfaces, lower fees, and higher interest rates on savings accounts, appealing particularly to tech-savvy millennials and Gen Z consumers who prefer to manage their finances digitally. On the regtech side, new technologies have streamlined compliance and reporting processes, enhancing their ability for consumers to protect their personal data and manage privacy settings. The implementation of strong customer authentication processes has increased security and trust in online transactions, influencing a greater willingness among consumers to engage with digital financial services. Additionally, investment platforms like Robinhood have democratized access to stock markets, allowing users to trade stocks without paying commissions, which has attracted a new generation of retail investors. The integration of AI and machine learning for personalized financial advice, through platforms like Betterment, has also made wealth management services more accessible to a wider audience. These examples illustrate a shift towards a more digital, user-centered approach in financial services, driven by fintech and enabled by regtech innovations. How are fintech developments differing between developed and developing countries, beyond the broad categorization of fintech 3.5 and 4.0? Fintech developments in developed countries often focus on enhancing and disrupting existing financial services. For example, in markets with well-established banking sectors, fintech innovations have led to the creation of advanced payment solutions, wealth management apps, with robo-advisory services, and peer-to-peer lending platforms. These innovations tend to target efficiency improvements, cost reductions, and the provision of more personalized financial products. In contrast, fintech in developing countries frequently centers on providing basic financial services to previously unbanked or underbanked populations. Mobile money platforms like M-Pesa in Kenya have revolutionized access to financial services, allowing users to deposit, withdraw, and transfer money, and pay for goods and services directly from their mobile phones, without the need for a traditional bank account. This has had a profound impact on economic inclusion, enabling small-scale entrepreneurs to participate more fully in their economy and improving household financial resilience. Additionally, in many developing countries, fintech firms are leveraging technology to improve financial literacy and awareness, which is essential for fostering financial inclusion. They are also often involved in the creation of alternative credit scoring systems that use non-traditional data, enabling broader segments of the population to access credit. While fintech in developed countries is characterized by incremental innovation and market competition, in developing regions, it is more about radical inclusion and building entirely new market infrastructure. Both are utilizing technology to advance their financial sectors, but their differing starting points and objectives lead to distinct pathways and outcomes in their fintech ecosystems. What are the key challenges for regulators in striking a balance between fostering innovation and preventing financial risks? One of the principal challenges for regulators is managing the dual mandate of promoting innovation in the financial sector, while at the same time protecting the stability of the financial system and the interests of consumers. As fintech firms introduce new technologies and business models, they can create value and efficiency, but also bring potential risks that may not be fully understood or regulated under existing frameworks. A significant challenge is the pace of technological change, which often outstrips the speed at which regulations can be developed and implemented. This gap can lead to a regulatory lag, where new financial products or services operate in a gray area without clear oversight or consumer protection. Moreover, regulators must contend with the complexity of new technologies, such as blockchain and artificial intelligence, which require deep technical expertise to regulate effectively. Another challenge is ensuring a level playing field between traditional financial institutions and fintech startups. Established banks are often subject to stringent regulatory requirements, while newer firms may operate under more permissive regulatory environments, such as sandboxes. This can create competitive imbalances and potentially expose the financial system to risks if unchecked innovation leads to systemic vulnerabilities. Additionally, cross-border operations of fintech companies add another layer of complexity, as regulatory standards differ between jurisdictions, raising questions about enforcement and cooperation among international regulatory bodies. Regulators must also be vigilant about cybersecurity risks, as financial services increasingly rely on digital infrastructure. Ensuring that fintech firms have robust security measures to protect against data breaches and cyber attacks is paramount. Finally, maintaining consumer trust is crucial. Regulators have the task of ensuring that consumers are adequately informed about the risks and benefits of new financial products, and that there is transparency and fairness in how these products are marketed and used. In summary, regulators face the challenging task of fostering an environment that encourages innovation and benefits consumers, while ensuring that risks are identified, managed, and mitigated to prevent harm to the financial system and its participants. How has the entry of big tech companies into finance changed the competitive landscape for traditional financial institutions? The entry of big tech firms into the financial sector has dramatically shifted the competitive dynamics for traditional financial institutions. Big tech companies like Amazon, Google, and Facebook bring substantial customer bases, strong brand recognition, technological prowess, and vast data resources, enabling them to offer a range of financial services effectively and at scale. One major change is the customer expectations regarding convenience, speed, and personalization. Big tech firms excel in leveraging data analytics and AI to create seamless and intuitive user experiences, raising the bar for traditional banks and financial services firms that may struggle with legacy systems and processes. Furthermore, big techs often have significant financial resources to invest in innovation and technology, allowing them to move quickly and experiment with new financial products and services. This agility poses a challenge to traditional financial institutions, which typically face more regulatory scrutiny and longer development cycles for new offerings. The big tech incursion also introduces a new level of competition in terms of customer engagement and loyalty. With their established platforms and ecosystems, big tech companies can integrate financial services into their broader offerings, making it convenient for customers to adopt their financial products. Another impact is on data utilization. Big tech companies' expertise in data analysis and artificial intelligence provides them with insights into consumer behavior that can be used to tailor financial services and products, potentially outperforming the data capabilities of traditional banks. However, the increasing presence of big tech in finance has also prompted concerns around market concentration, data privacy, and financial stability. Regulators are closely examining how to apply existing financial regulations to these new entrants and determining whether new regulations are needed to address these unique challenges. In summary, the foray of big tech companies into finance has forced traditional financial institutions to innovate and adapt, while also prompting a re-evaluation of regulatory frameworks to ensure that the financial system remains stable, competitive, and fair. What measures are being put in place to ensure that entities like Ant Financial and platforms like Libra do not pose systemic risks to the global financial system? To address the systemic risks posed by large fintech entities and platforms, regulators and international financial bodies are implementing a range of measures. Firstly, there is an increased emphasis on comprehensive oversight. Entities like Ant Financial are being subjected to similar regulatory scrutiny as traditional banks, especially when they offer bank-like services. Regulators are ensuring that these companies hold sufficient capital reserves and follow strict risk management protocols. For platforms like Libra, now known as Diem, regulatory bodies worldwide are working to apply a consistent set of standards that govern traditional financial transactions, including anti-money laundering, AML, and combating the financing of terrorism, CFT, regulations. There is also a focus on interoperability and open banking standards, which aim to reduce the potential for monopolistic practices and encourage a competitive environment where no single entity can dominate the market to the extent that it becomes systemically important. Additionally, stress tests and scenario analyses are becoming more common, where fintech firms are required to demonstrate how they would handle adverse economic conditions. This helps ensure that they do not become a point of failure that could trigger wider financial instability. International collaboration is another crucial measure. Since many fintech companies operate across borders, global financial institutions, like the International Monetary Fund, IMF, and the Financial Stability Board, FSB, are coordinating with various countries' regulators to create a unified approach to fintech regulation. Lastly, there is a push for consumer protection laws to be updated to account for the new ways in which financial services are delivered. This includes ensuring transparent pricing, fair terms of service, and the safeguarding of customer data, which is particularly important given the data-driven nature of many fintech platforms. These measures reflect a broader understanding that while innovation in financial services can bring significant benefits, it must not come at the expense of financial system integrity or consumer trust. What are the potential economic implications of widespread CBDC adoption for international trade and monetary policy? The widespread adoption of central bank digital currencies, CBDCs, has the potential to significantly impact international trade and monetary policy. Here are some potential economic implications. International trade efficiency. CBDCs could streamline cross-border transactions by reducing the need for intermediaries, thereby lowering costs and speeding up settlement times. This increased efficiency could boost international trade, especially for small and medium-sized enterprises that may currently face prohibitive costs and complexities in accessing global markets. Monetary policy transmission. CBDCs could enhance the transmission of monetary policy by allowing central banks to implement policy changes more directly. For instance, if interest rates are negative, CBDCs could be programmed to reflect that, potentially making monetary policy more effective during economic downturns. Financial inclusion. In developing countries, CBDCs could promote financial inclusion by providing access to financial services for individuals who are currently unbanked or underbanked, thereby integrating them into the formal economy and enabling participation in international trade. Exchange rate dynamics. CBDCs might alter the dynamics of foreign exchange markets. With easier access to different currencies, there could be shifts in demand for certain currencies, which might affect exchange rates and trade balances. Reduce currency substitution. Countries facing high inflation rates often see their citizens adopt foreign currencies for trade and savings. CBDCs, if trusted, could reduce this currency substitution by providing a stable digital alternative. Impact on international capital flows. The ease of transferring CBDCs across borders could lead to more volatile international capital flows, as investors could more readily move funds in response to market conditions or changes in monetary policy. Challenges to the dollar dominance. The introduction of CBDCs by major economies could challenge the US dollar's dominance in international trade and finance, particularly if cross-border CBDC transactions become more prevalent. Data and surveillance. CBDCs could give central banks access to large amounts of transaction data, which could be used to monitor economic activity more closely and tailor monetary policy more effectively. However, this raises concerns about privacy and surveillance. Central bank coordination. To mitigate risks like capital flight or exchange rate instability, there will be a need for increased coordination among central banks on how CBDCs are managed across borders. Overall, while CBDCs hold the promise of significant benefits, they also present challenges that will require careful design and international cooperation to ensure they contribute positively to the global economic system. How is digital identity being integrated into financial services, and what are its implications for privacy and security? The integration of digital identity into financial services is transforming the way customers access banking and financial products. By using digital identity verification methods, such as biometric authentication, document verification, and e-signatures, financial institutions can streamline the onboarding process, reduce fraud, and enhance user convenience. For privacy and security, the implications are twofold. Enhanced security. Digital identity systems often employ advanced security protocols and encryption, making it more difficult for unauthorized users to gain access to financial accounts. Biometric data, like fingerprints or facial recognition, can be more secure than traditional passwords, reducing the risk of account breaches. Data privacy concerns. At the same time, the collection of personal and biometric data raises significant privacy concerns. There is a risk that financial institutions could misuse personal data, or that this data could be exposed in a cyber attack. Moreover, the centralization of sensitive data could make financial institutions a more attractive target for hackers. To address these concerns, regulatory frameworks such as the General Data Protection Regulation, GDPR, in the European Union enforce strict rules on data processing and storage. Financial institutions are required to obtain consent from customers before collecting or using their data, and must ensure that the data is kept secure. In summary, while digital identity systems can offer improved security for financial transactions and greater efficiency in the delivery of financial services, they also necessitate robust measures to protect privacy and personal data.